Welcome back. We're going to do one easy example of withholding and payroll, and one a little bit harder. All right. So here we've got an example. Blake Edwards worked 46 hours. Your brain should go ding, 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 more than 40. His regular wage rate is $19 an hour. So we already know that he's going to earn some time and a half money, right? Prior to the week of July 21st, he's earned $26,100. They're telling you that because they want you to realize that he has not reached the Social Security cap yet. In addition, whatever, they tell you. They don't make you calculate. Federal income tax is $130, state and local taxes is $48, United Way, okay, and so on. So let's look at the gross part of it first, the gross pay. Gross pay, he worked 40 hours at $19 an hour, and he worked some time and a half as well. So whatever 19 times 1.5 is, he made $28.50 an hour for 6 additional hours. That comes out to $931 of gross pay. His deductions, they tell you his Social Security, they tell you his federal income tax. All right, fine, we're going to start with Social Security. Social Security is 6.2%. It's been that way since I was an undergrad, and 1.45 since Medicare. They just changed that threshold here, but the numbers have stayed the same. So Social Security is $931, the gross pay, times 6.2%, and Medicare is 1.45 times the gross pay, right? So there you go, it's $13 coming out. All right, now we're going to look at federal income tax. We've got $130. They're not making us calculate it, just giving us the number. State and local taxes coming out $48. Just a note, lots of states have local income taxes. For example, our neighbors to the west, Pennsylvania, they have a lower state tax, but they also have local taxes. So not to be discounted, it's still out there, meaning that you're paying your municipality or the county you live in an additional 1.5% tax. So they actually do 3 tax returns in Pennsylvania. They're federal, they're state, and they're local. All right, New Jersey does not have that. Thankfully, we pay enough. Then beyond that, you could have things like United Way. United Way is just a typical charitable organization, and you can elect to do that through your payroll. For example, I contribute to the RBCC student fund with every paycheck. That's a choice I make. It's fine. It can come out of your paycheck directly. $5 there, and health insurance, $20 is coming out, making the net pay $657. Okay, so kind of a simple, straightforward example. Let's get into the more complicated one. All right, so now we're going to actually move myself. Ready? I'm going over there. All right, this one gets a little bit more complicated because what we're doing is we're hitting the Social Security cap, and I wanted to make sure we covered one of these. So we've got Lily Carter working for JDK all year. Remember, it's not 118.5 anymore. I just wanted to say that. It's higher, 142, that I had in a couple of slides ago. But these problems are a little bit older from the previous edition of the book, so they're 118.5. Okay, back to the problem. Lily Carter works for JDK all year and earns a monthly salary of $12,100. There's no overtime pay. Okay, so she's just a salaried employee. Her income tax withholding rate is 10%. They tell us that. In addition, she contributes to the United Way. She also deducts $250 for health insurance. And as of September 30th, she has 108.9 of cumulative earnings. And that's kind of the key here. She's at the 108.9. She's not real far from the 118.5. She only has to pay that 6.2% to 118.5 and then not beyond there. So we don't want her paying more than she has to. So her gross pay is $12,100. They tell us that. Okay, it's a monthly pay. Nobody actually gets paid monthly, but I guess it makes these problems easier. All right, the withholding deductions, or at least nobody I've ever met. Federal income tax, easy, 10%. No problem there. But let's look at the other piece. Now we're going to look at Social Security and Medicare. They don't have state tax in here at all in this particular problem. So what I did for you is I made you a little line here to kind of illustrate it. So here she is now. She has made 108.9 at this point. That's how much she has earned in total. All right, she is going to be at $12,100. I'm sorry, she's going to be at $121,000 after she gets her next pay, because she gets paid $12,100 every month. So 189 plus the $12,100 puts her at $121, which is clearly above that $118.5. We only want her to pay taxes up to the $118.5 though. So she's only going to pay taxes really on this piece right here, $9,600. Those Social Security taxes will only get paid on this $9,600. She is not going to pay the 6.2% on anything over that $118.5. All right, So that 9,600, here you go. I gave it to you, so I showed it to you in the timeline, but I wanted to give it to you numerically as well. So 118.5 is the max, that's the cap, minus the 108.9, right? That's where she is, that's 9,600. That is the piece still subject to Social Security tax. So 9,600 at 6.2%, she's going to pay 595 too. And going forward, she'll almost get like a little bit of a raise in her payroll, in her paychecks going forward, because she won't be paying that 6.2% on anything for the rest of the year. All right, so there you go. The OASDI, Social Security tax. Medicare, you're paying that 1.45%, no cap at all on that 12,100. Health insurance, elected, United Way, she also chose for that 5%, and that gives you total withholding deductions of $28.35, so her net pay is going to be $92.64.35. Okay, I wanted to give you an example where we capped out there. All right. So let's talk vacation pay benefits. Let me move myself back to the right corner. There we go. All right, vacation pay benefits. We're almost at the end of this chapter here. How do employers have to capture vacation pay benefits, right? The idea is that as employees work, they earn vacation time. And you may even see this in your paycheck, that you earn a day or you earn 6 hours, right? You may see it accumulating on the bottom of each paycheck. Some businesses may not let you take it before you accumulate it. Those are the worst. Some let you take it before you do accumulate it. Like you could take a week off in January, even though you haven't actually earned a week off at that point. It's up to each company how they want to do it. But they do have to record the fact that they owe you money. They owe you vacation pay. They accumulate it as a liability. So here's the example. Samuel Industries has 3 employees. Each employee earns 2 vacation days a month. Samuel pays each employee a weekly salary of $12.50 for a 5-day work week. So let's take this apart here. We have 3 employees. They earn 2 vacation days per month, so we have to accrue 6 days worth of vacation time. Each employee makes $12.50 for a 5-day work week, right? So that means really they earn $2.50 per day. Agreed? $12.50 divided by 5. They earn $2.50 a day. So $2.50 a day for 6 days, right? The 6 days we have to accrue, $1,500. Journal entry, easy. Debit vacation benefit expense, it's an expense, right? It's an expense of doing business. You have to pay your employees for vacation time. Well, not everybody, but most employees. And I say that because I mean some employees do not accrue vacation time. Some hourly employees, if they don't work a lot. All right, there's rules on that. Every state has its own. And the last piece is vacation benefits payable for the $1,500. So we set up the liability for ourselves, a short-term liability. And as people start taking vacation time, then we would debit this vacation pays payable and reduce the liability and pay them. All right, last piece, contingent liabilities. A potential liability based on a future event. Well, that's confusing, right? But let me give you an example of probably the most simple contingent liability, a warranty. People buy warranties, right? You buy a new refrigerator, you have a warranty on that refrigerator, usually for at least a year, and then you buy extended and all that kind of good stuff. But the point is, it is a potential liability for a business because they have, if I buy a refrigerator with a 1-year warranty, it could break down in the next year. That is a potential liability to the business that sold it to me based on a future event, right? So contingent liabilities could also be things like lawsuits, right? Because you don't know what the outcome is going to be. And the thing is what we have to do with contingent liabilities is we have to assess what the likelihood is of that liability happening, all right? So let's go with lawsuits because it's a little bit easier to get your head around. Let's say it's remote. You're being sued and it is the most ridiculous lawsuit in the world. If that's the case, you don't have to do anything because you're like, there's no way that I'm actually going to owe anybody money at the end of this lawsuit. So if it's remote, we do nothing. But what if it's possible? What if it's reasonably possible that we could lose this lawsuit? But we're not sure. Like it's not like for sure. It's possible. And don't worry, the book's going to tell you whether or not it's going to be, which category this is going to fall in. But what if it's possible? If it's possible, what we have to do is we have to include it in the footnotes of the financial statements. Meaning we say, hey, we're being sued by so-and-so. It's possible that we could owe the money. All right, just so that the readers are aware. Okay, now what if it's probable? What if you did something and you know that you are going to owe money? If it's probable, but I can't estimate the amount. Like, it's just, we have no idea what we're going to owe. There is no possible way we can come up with a number for our financial statements. Then we still do the same thing. We disclose it in our footnote saying it's possible, it's probable, but we have no idea what we're going to owe. Okay, what if it's probable? Like, we know we're going to owe it, and we can estimate it. So we know we're going to maybe owe $1 million. We know. If that's the case, we have to actually record the expense and the liability. Okay, so you haven't even been, maybe you haven't even lost the lawsuit yet, but it's probable and you can estimate it. You're going to accrue the expense. Now you might think to yourself, how am I going to remember all these? Well, let's look at it like it's a spectrum. If it's remote, you do nothing. Nothing at all. If it is really, really likely and you can estimate the amount, then you have to record it as an expense and a liability. Okay? Anything that falls in between those two, you have to include as a footnote to the financial statements. So hopefully that's helpful. All right, so we said it must be both. It must be probable and estimable to record the expense and the liability. If that's the case, we would debit the expense and credit the liability. All right, like I said, the common example is warranty. So if you know in business, you know that refrigerators break down and you're going to wind up owing, warranty costs. What you would do is when you made the sale, right? We are selling someone refrigerators or a refrigerator. We would record the expense up front, whatever that might be, $100. We would debit warranty expense and credit warranties payable for the amount that we estimate that we might owe on that refrigerator. Okay, so that is the most common one that you can think of. And that is the end of our chapter. See you for the next one.